Good morning, everyone. We are Group 8, and today we will be presenting our project on stock price time series forecast exploratory data analytics as a part of DSCI 591 course. Our team members include Ahmed Javed, Steven Sullivan, Robert, and myself, Uditi Shah. So, in this presentation, we are gonna walk you through our approach to analyzing historical stock data for four major automobile manufacturers: Ford, Volkswagen, Toyota, and Tesla, to understand market trends and investor behavior. Our goal was to pre process and clean the data, address challenges such as missing values, inconsistency, and conduct exploratory data analysis to uncover meaningful insights. So, our project we selected these companies to analyze trends in both traditional and electric vehicle markets. The acquisition process involved downloading structured CSV files, ensuring consistency, and standardizing formats for accurate analysis. During pre-processing, we handled missing values, inconsistent volume formatting, and data noise using statistical methods like median imputation and numerical conversions. Standardizing data formats enabled effective time series analysis and ensuring data integrity for predictive modeling and financial insights. Then we will walk you through the exploratory data analysis, which will help us understand the stock data before moving to forecasting and feature engineering. Our goal with EDA is to identify trends, patterns, and relationships in stock prices and trading volumes for all the four stocks. This process ensures that our data is clean, reliable, ready for modeling. To begin, we calculated key summary statistics such as mean, median, and standard deviation for stock prices and trading volumes. This gives us basic understanding of how the stock values fluctuate over time. By analyzing these metrics, we could identify which stocks showed the highest volatility and which were relatively stable. Next, we analyzed how stock prices evolved over the 5-year period. We plotted line charts for closing prices to observe overall trends. We noticed that all the four companies experienced fluctuations due to major market events, economic shifts, and industry specific news. Additionally, we examined trading volume, which helped us identify periods of high activity, often coinciding with corporate announcements or broader market movements. Next, to understand the spread of stock prices, we used historic histograms and box plots. Histograms helped us visualize how frequently certain stock prices occurred, while box plot allowed us to identify any outliers, sharp spikes, or drops in prices that deviated from normal trends. These outliers often indicated market shocks or unexpected events affecting investor sentiment. We then analyzed the correlation between different stock prices. Features such as open, high, low, and close prices. As expected, these features showed strong positive correlations, meaning they moved together in predictable ways. To visualize this, we used a heat map, which provided a clear representation of how different price metrics were interrelated. Additionally, we explored whether trading volume had any significant impact on price movements. Lastly, we applied moving averages to smooth out short term fluctuations and highlight long term trends. This allowed us to observe momentum shifts in stock prices. We also calculated rolling standard deviations to measure volatility, helping us determine how much a stock price varied over time. High volatility often indicates uncertainty or rapid market reactions, which is crucial information for forecasting models. Through this EDA, we gained important insights into stock behavior, volatility, and trends. These findings laid the groundwork for building our forecasting models, ensuring that we used well prepared data with meaningful patterns. Now, let's move on to our next chapter.
Feature engineering is one of the most important steps in building an accurate stock price forecasting model. Raw stock data often contains fluctuations, redundancies, and noise, which can mislead predictions. The goal of feature engineering is to transform this raw data into a structured, informative format, allowing the model to detect meaningful patterns. In our project, we applied trend smoothing, correlation analysis, and feature selection techniques to optimize our dataset. These transformations allowed the model to focus on long-term trends and market behaviors, rather than reacting to daily fluctuations. Let's start by looking at one of our key feature engineering techniques, rolling averages. One of the most effective feature engineering techniques we applied was rolling averages, which smooth out daily fluctuations in stock prices. This plot shows Volkswagen daily stock prices, blue, alongside the weekly red and monthly green moving averages. These averages help highlight long-term trends by reducing the impact of short-term volatility. The weekly moving average captures shorter-term patterns, while the monthly moving average provides a broader view of sustained trends. This ensures that our model focuses on the underlying stock trajectory rather than reacting to daily market noise. Additionally, we introduced volatility measures, which quantify stock stability over different periods. These features allow our model to distinguish between stable and highly volatile stocks, improving forecasting accuracy. Now, let's look at how we analyzed correlations to refine our dataset. To further refine our dataset, we performed correlation analysis to determine which features contributed the most predictive value. The goal was to remove redundant features while retaining the most meaningful ones. Looking at Volkswagen's correlation matrix, we observed that open, high, low, and close prices were highly correlated. This means they contained overlapping information, so we removed some of them to simplify our dataset without losing predictive power. Additionally, we found that trading volume had a weak correlation with stock price movements, suggesting it wasn't a strong predictor. On the other hand, engineered features like the 7-day moving average and 30-day volatility showed strong correlations with price for the Volkswagen stock, confirming their importance for forecasting. By keeping only the most valuable features, we optimized our dataset, making it more efficient for training models. After applying feature engineering, we observed clear improvements in our dataset. Rolling averages helps detect long-term price trends, allowing the model to focus on meaningful stock movements rather than short-term fluctuations. Our correlation analysis showed consistent findings across different stocks. In Volkswagen, open, high, low, and close prices were nearly identical, making some features redundant. We observed the same pattern in Tesla's correlation matrix, reinforcing our decision to remove these redundant variables. Additionally, in both Volkswagen and Tesla, trading volume showed a weak or negative correlation with stock prices, suggesting it wasn't as strong of a predictor for forecasting price changes. This validated our choice to focus on features with higher predictive value. Finally, both Tesla and Volkswagen demonstrated that engineered features like the 7-day moving average and 30-day volatility maintained strong correlations with price, confirming their importance in capturing market trends. By selecting these meaningful features, we improved the efficiency of our model while maintaining strong forecasting accuracy. This completes our feature engineering process. Next, we will present our finalized data.
Now, as previously mentioned, we already took some steps to clean and verify the data. We converted to date time format. We dropped missing variables, but there are some other steps we need to take before this can be finalized. The most important one is we need to take steps to deal with data leakage. Now, data leakage occurs when a model is given access to data that would not have been available at prediction time, which is known as look-ahead bias. To deal with this, we created lagging features. Lagging features are important for time series forecasting because they help show trends in seasonality, and they enable models to learn from past behavior. Data leakage which interfere with lagging because it inserts data from the future into the analysis. Therefore, it is helpful to shift the data slightly, so only data from before a certain point is used. After that, the final step of preparation was splitting the data. We split it into training portions and testing portions. The training portion, of course, took up about 80% of it, and the testing portion took up another 20%, which is a fairly standard distribution. After this, we need to examine different styles of different models of pipeline models for our machine learning portion. Overall, the main approach is time series forecasting, which uses historical data to predict future values. In this case, we look at trends in the stock prices and use them to predict future prices. Now, there are different approaches to choose from with this. ARIMA, or Autoregressive Integrated Moving Average, is a major one. It is a statistical model used for analyzing and forecasting time series data by combining autoregression, differencing, and moving averages to capture patterns over time. Therefore, that makes it a very good choice for stock prices. Now, in this case, if there is strong seasonality in our data set, we would use SARIMA, which is an alternative of ARIMA that is better suited for seasonality data. There are, however, other machine learning models to examine, such as linear regression and random forest. However, neither of those are the best choices. Linear regression is bad for long-term nonlinear patterns, although it is good for the short term, as is random forest. Other options that might be better choices are XGBoost, which handles large data sets well, although it isn't always the best for purely sequential data, and long short-term memory, which is designed for sequential data and good for long-term dependencies, but not always easy to interpret. We therefore have many options for our next step in this project, and we'll examine them thoroughly before choosing one.
Throughout our project, we learned a lot about the processes of data acquisition, data preprocessing, data analysis, and data exploration. Ensuring the data is clean and consistent is crucial for accurate analysis. Missing values in key columns such as volume and price can distort our results. Addressing this by filling missing data with median values helps maintain the integrity of the data set. When working with multiple data sources, in our case, Ford, Volkswagen, Toyota, and Tesla stock, it's essential to standardize columns like volume and percentage change. This involves converting units, such as M for millions, and removing non-numeric characters to ensure consistency and comparability across datasets. In our case, we had to remove dollar signs from prices in order to make sure that the values could be used for numerical data. Outliers, identified through visualizations like box plots, can heavily influence stock and price analysis. It's important to identify and address outliers to improve the accuracy and reliability of the results. Visualizing data, such as stock prices and trading volumes over time, is key to identifying trends and spotting outliers. For example, spikes in trading activity and significant price movements on specific days provided valuable insights into market behavior. By analyzing the correlations between variables, we identified which factors were most relevant for predictive modeling. This process helps reduce redundancy in the model and ensures that the focus is on the most impactful features. Ensuring that the date column is formatted consistently is essential for time series analysis. Inconsistent date formats can lead to misalignment of data across different stocks, potentially disrupting the accuracy of the analysis. For our project, we wanted to look at what influences car stocks the most, and we've broken it down into 5 categories. The first are macroeconomic factors. This involves interest rates, inflation, and consumer spending. The next is industry-specific factors. These can include car sales and car demands, electric vehicle transitions, and vehicle recalls. The third is market and competitive factors. These include earning reports, mergers, acquisitions, and partnerships. The fourth is government policies and regulations. This includes emission standards, electric vehicle incentives like tax credits, and trade policies and tariffs. The fifth is global events and disruptions. This includes geopolitical conflicts, which include wars, trade wars, and pandemic. For our next steps, we're going to be focusing on creating a predictive model following the ARIMA model. This type of time series forecasting needs some setup and analysis that we are going to be focusing on in phase 2. It's crucial to index a dataset by date and ensure the date column is in the correct date-time format. This step is vital for time series analysis as it preserves the order of data points. ARIMA models require the time series to be stationary, meaning that its statistical properties, such as mean and variance, remain constant over time. Ensuring this is a key step in preparing the data for accurate modeling. Additional analysis is also going to be focused on in phase 2. To enhance predictive power, adding external data sources such as news articles and social media trends related to the companies can provide additional insights. And finally, we want to also make sure that our model is valid and can be used in the future. It's important to validate our model using unseen future data. In this case, it will be the first few months of 2025, roughly from January to March, to ensure that our model performs well in predicting outcomes which result in providing long-term accuracy. Thank you for listening to our presentation.